In this section, we'll turn RWA theory into a practical playbook. You'll learn how to structure a core plus satellite portfolio, spot structural red flags and too good to be true yields, and apply a simple checklist for vetting institutional-grade RWA deals. Picture your crypto portfolio as a structure. Pure DeFi is the lightweight metal frame. Fast, reflexive, fully on-chain, but driven by sentiment and meme volatility. Real-world assets are the concrete pillars. They connect you to steady, real economy cash flows that don't care what CT is doing, and they diversify you away from purely speculative bets. The trade-off is weight, off-chain counterparties, legal contracts, and operational complexity. So every RWA decision really comes back to one question. Does the yield truly compensate you for that extra off-chain risk? Now reframe your RWA exposure as a pyramid. At the base is your core, boring by design. These are stable, transparent positions where you're comfortable parking larger size and accepting lower yield for reliability. Above that is your satellite layer. Here you take targeted, moderate risk for higher yield or specific themes, like a niche credit pool or a particular jurisdiction. At the very top is opportunistic capital. Small, high risk, event-driven, or experimental bets. Treat these like venture tickets and assume they can go to zero. Your core RWA allocation is the yield anchor of a crypto portfolio. Its role is straightforward: steady income, high survival odds under stress, minimal blowups. Typical instruments here are treasury-backed tokens, tokenized money market funds, and conservative asset-backed lending. The non-negotiables are clean legal structures, frequent liquidity, reputable issuers, and transparent reporting, so you always know exactly what backs your yield. Satellite allocations are where you reach for extra yield without going fully degen. Think of them as targeted bets on real-world credit, SME loan pools, real estate credit lines, or trade finance platforms. They usually pay more because you're closer to actual business risk, not just treasury rates. In return, you accept more complexity, sector concentration, exposure to credit cycles, and heavier legal plumbing. You size these positions smaller, insist on clear data and structure, and use them to complement a safer core RWA base. Opportunistic RWA allocations are your highest octane bets. These are experimental tickets where you only risk capital you can fully lose. They often involve brand new protocols, distressed or complex debt, or exotic jurisdictions with fuzzy rules. Yields can look insane, but so can the downside. Weak legal protection, extreme illiquidity, platform blowups, and sudden regulatory moves that can wipe out your position overnight. Pulling this together, your RWA portfolio breaks into three buckets: core, satellite, and opportunistic. Core is the stability engine. A conservative investor might keep most RWA exposure in tokenized treasuries or money market-style assets, while an aggressive investor uses core mainly as a safety rail. Satellite positions layer on diversified credit to lift yield without blowing up overall risk. Opportunistic bets are the spicy slice. Conservative investors usually skip them, balanced profiles keep them tiny, and only experienced investors size them meaningfully, with strict risk controls. When you evaluate an RWA deal, assume the weak point is usually the legal plumbing, not the smart contract. If the pitch leans heavily on code as law, but the asset lives in a messy real-world jurisdiction, you're taking legal risk you can't see on-chain. Red flags include vague SPVs with no concrete entity details, missing or fuzzy recourse in default, and no named law firm or legal opinion. These aren't minor issues, they're structural risks, and they should directly cap how much capital you allocate. Anytime you look at an RWA opportunity, treat the data as a potential mirage until it's verified. Start with yield. If returns are far above comparable TradFi assets, you need a concrete, numbers-based explanation for that premium, not just vibes or marketing. Then check telemetry, audited financials, default and recovery history, and performance through at least one stress period. If these are missing, you're flying blind. Also, treat buzzwords and vague institutional-grade claims as warning signs. Real operations are documented, repeatable, and tied to named, accountable parties. Misaligned incentives are the classic trapdoor in RWA. Watch for 4 patterns. First, front-loaded value capture. Platforms take big origination or setup fees up front, while investors hold all the long-term default risk. Second, zero skin in the game. The originator doesn't keep junior, first loss capital, so they get paid whether loans perform or not. Third, token emission masks. Inflated APYs from governance tokens hide weak real-world economics. Fourth, asymmetric payouts. Platforms earn ongoing fees even as credit performance deteriorates. When you first encounter any RWA deal, run 4 quick filters in your head. 1. Asset identity. Can you clearly name the real-world asset and how it's valued? Or is it just a vague pool plus marketing buzzwords? 2. Legal counterparty. Which actual entity owes you money, in which jurisdiction, and under what license or regulatory regime? 3. Source of yield. Who is ultimately paying, and from what underlying economic activity? 4. Exit. How and when can you redeem, and what specific events can block or delay that? Deeper due diligence in RWA is about turning vague trust into concrete questions. First, data visibility. Can you actually see track records, stress tests, and regular portfolio reports? Second, oversight. Who's watching the watchers? Look for real auditors, trustees, or custodians with skin in the game. Third, hidden concentration. Is risk quietly piled into one big borrower, one shaky sector, or one risky country? Finally, model the crash. If defaults spike or regulators step in, who gets paid, who absorbs losses, and on what timeline? Treat this workflow as your personal RWA operating system. Start by defining what you're trying to build. A core yield base, plus satellite and opportunistic bets that still fit your risk tolerance. Then, attack downside first. Interrogate every legal claim, incentive, and narrative until you're satisfied you understand exactly how you could lose money. Next, run diagnostics the same way every time, using consistent checks on the asset, legal structure, source of yield, and exit. And finally, only execute what you fully understand, and write down your decisions so your judgment and process compound over time.